What is counterparty risk? You may have heard that term tossed around a lot lately, particularly with the banking crisis that is making the news. If you don't know what counterparty risk is, you're going to want to know. And if you don't know what it is, you've come to the right place, because I'm Professor Capko, and I'm here to explain this to you in simple terms. But first, I want to mention that I believe something great is going to happen for you today. Now, back to the video. I'm going to get the definition from this article on Investopedia. I do like Investopedia as a starting spot for definitions or ideas and formulas, things like that, that an investor or any kind of business person might need to know. Of course, you want to dive deeper on many things, but it's a good starting spot. This is an article by Chris Murphy, and it was recently updated as of March 28th of 2023, so it should be fairly up to date. Again, you may have heard the term counterparty risk thrown around and not know what it is. Counterparty risk is the likelihood or probability that one of those involved in a transaction might default on its contractual obligation. Counterparty risk can exist in credit, investment, and trading transactions. So any kind of obligation there's a possibility that one party might default, that involves counterparty risk. Let's take a look at a little bit more. So degrees of risk exist in financial transactions. We usually think of counterparty risk in regards to a loan. Maybe a bank makes a loan and there's a risk that the borrower won't live up to their contractual obligations to repay that loan or to timely repay that loan, and therefore the bank is assuming a certain amount of risk in making that loan, and that there's a lot of factors that go into the bank's decision on that. But one thing that does factor in is the greater the counterparty risk, the greater the reward that the bank will be seeking to offset that risk. In other words, the higher interest rate. If it's a safe investment, if it's a safe loan, the safer the loan, the lower the interest rate that will likely be negotiated. But if it's a very risky loan, if there's a high risk that a loan will not be repaid, well, then generally the bank or the lender is going to seek a higher interest rate to compensate for that risk. Hence, you have a whole subprime market out there where folks who may not be as creditworthy as the highest levels might still be able to get loans, but at a much higher interest rate. Likewise, if you take a look at your credit card interest rate, usually it's much higher than, say, a mortgage rate. One reason would be that there's collateral for the mortgage is a collateralized document. It puts the property up as collateral for the loan. However, with credit cards, often there is no collateral. Somebody uses a credit card to buy dinner, and if they default on that, well, it'd be really hard to repossess dinner. I don't think you'd want to do that. So that is an example of where the interest rate may vary based upon the amount of risk. Counterparty risk is also known as default risk. Default risk is the risk that the chance that companies or individuals will be unable to make the required payments on their debt obligations. So far, this is nothing that you don't already know. You may have not had the terminology, and you may have realized that, well, there is some risk to the bank that a borrower won't repay. However, we need to be concerned with any kind of transaction in which the other party has to perform. And there's all kinds of things out there that involve this kind of risk. For example, if you are depositing your money in a bank, there is counterparty risk to that. The bank, you are lending money to the bank. That money is not placed in a vault. It is lent out to others. So you are assuming a part of that counterparty risk, because if the bank has too many defaults on its loans, then it may be in a position where they're insolvent and unable to repay your deposit when you want to withdraw it. Now, of course, there is FDIC insurance that covers certain deposits up to $250,000, but that doesn't mean you have nothing to worry about. The FDIC, if there was a major banking crisis, would not have enough assets to cover all of the bank 50,000 in a systematic way. So you have to worry about whether or not the government's going to step up and make the banks whole, or at least make the depositors whole, as was done in the crash of 2008. Well, one thing to think about is, where's the money going to come from to cover all of this risk? Well, it's going to probably come from the taxpayers, and there's some unique ways that are being kicked around to cover this. One thing that the Fed might do would be to launch a CBDC. You may have not heard that term before, but that stands for Central Bank Digital Currency. And that is something that we would want to talk about in a separate video. So if you're interested in something along those lines, please put a comment down below and let me know. But now you know what the term counterparty risk means, and now that you know it, you will probably hear it more and more, particularly if the economy keeps going in the direction that it's going at this time. So make sure you're an informed consumer. Make sure you are protecting yourself. This is not legal, certainly not financial advice. I am just giving you this information for educational purposes so that you can be an informed consumer. If you like this kind of content, please smash that like button below and subscribe. Turn on that notification bell so you can hear more of what's out there, so you can learn more about what's going on in the world of finance and banking.